The global green bond market continues to grow, with outstanding green debt surpassing $1 trillion dollars and some segments like infrastructure almost completely migrating to green debt. As the market expands, how are indices helping investors assess greenium and make more informed decisions? Hello, I'm Paul Murdoch from S&P Dow Jones Indices, and joining me today to discuss green bond growth are Brian Luke, S&P DJI's head of fixed income indices in the Americas, Bill Sokol, senior product manager at VanEck, and Phil Kirouac, director of the insurance client business at VanEck. Brian, Bill, and Phil, thanks for being here today.
Great to be here.
Thanks for having me.
Thanks so much, Paul. Great to be here.
So, Brian, how has the green bond market changed in recent years, and what's driving demand today?
Yeah, Paul, what was originally a one-off transaction issued by quasi-government agencies to fulfill a very niche demand, the green bond market is now permeated through almost all facets of the bond market, which is why our flagship Green Bond Index covers most currencies, security types, and countries. We want to capture all of the different green bonds that are issued in the marketplace. So the growth has been tremendous. We've seen over 70% growth compounded annually since the inception of the green bonds took hold. And in terms of demand, we've seen a strong top-down and bottom-up push for green bonds. And what I mean by that is regulations are increasingly implementing new ESG principles into institutional benchmarks, therefore creating demand for green bonds. And from the bottom side, individual investors are realizing they can access all sorts of fixed income markets with comparative yields that they see in the global bond market, but with green bond principles in place.
Great, and that's a good segue. What is greenium and why can it be difficult to measure?
Yeah, Paul, essentially greenium is the difference in yield or spread that's offered by green bonds and their non-green or vanilla counterparts. And so it's really difficult to get a true apples to apples comparison. When you're talking about even bonds that have issued green and vanilla bonds in the same tenor and risk profile, you're still seeing technical supply constraints that can impact liquidity.
And Bill, how has the liquidity landscape changed for green bonds over the past decade? And do those trends apply across geographies and sectors?
Thanks, Paul. So, with the market growth that we've seen over the past decade, we have also seen a significant increase in liquidity as well. Historically, the market was dominated by these large institutional buy and hold investors, but we've seen a broadening out of the investor base. New institutional investors like insurance companies, but also individuals and advisors as well, thanks largely to new ways to access the market, including passive approaches like through ETFs. We've also seen new issuers come to the market with benchmark-sized new deals. Keep in mind that green bonds are like any other bond other than the use of proceeds. So these new issues are being included in both conventional bond indices as well as green bond indices. So that certainly had a positive impact on secondary market liquidity. With the growth in the market and liquidity, we've really seen this across all segments and geographies. So we've seen growth in certain segments of the market like sovereigns and corporates, and as well as emerging markets and high yield. And we've also seen it in the dollar-denominated segment of the market as well. That portion of the market has grown to over $220 billion based on the S&P US Dollar Green Bond Select Index. And that's been great for US-based investors who are looking for broad green bond exposure, because previously you had to take more of a global approach to get that exposure, and that meant taking on currency risk because the global market is 70% euro denominated. So with the growth in size and diversification and liquidity, we've actually seen the dollar segment really start to resemble a US aggregate type exposure in terms of its quality and multi-sector exposures. And we've also, in fact, seen return correlations between US aggregate bonds and US dollar green bonds increase significantly in recent years. So what it means for investors is that you can now build a sustainable and liquid core bond portfolio using green bonds, and you don't need to sacrifice yield or take on additional risk, including currency risk.
That's great, Bill. Thank you. And Brian, building on that, how can indices help investors measure the green bond market and better understand that potential opportunity set?
Yeah, with an index-based approach, it's really best to use it and evaluate the overall market and how it's performed. So, for example, comparing the green bond market with yields over 2% right now to the global developed sovereign bond indices that we calculate, you're seeing a yield advantage. What you also see is the ability with indices to further hone in on the risk profile an investor is looking for, whether it's a currency risk, a country risk, credit risk between government, sovereign, quasi, and corporate bonds, investment grade, a high yield, or even an interest rate sensitivity as we see rising rates come into the fold. We can target certain maturity profiles to capture and isolate the actual risks you see, and then measure that green bond index against its equivalent market. So, and when we talk about the changing, evolving greenium in the marketplace, that's exactly how we look at it and measure against the traditional bond market. And what we've seen is as that liquidity, as that increase in issuance comes into fold, the differential in greenium is compressing. Most notably in the European market, it's compressing because that's been the most established market. In the US market, we're still seeing the exact same behaviors, a compressing of yields to make green and vanilla much more on par with what the actual risk profile and interest rate profile and of course the overall performance in the market. That's evidenced by what Bill was talking about, the correlations we've seen in returns across the board.
Thanks, Brian. And Phil, for insurers looking to integrate more sustainability factors, how are they going about that?
Yeah, thanks, Paul. It's a great question. So at VanEck, we've been discussing the benefits of incorporating sustainability into investment portfolios for 6-7 years now. Through our partnership with S&P, we've been delivering rules-based solutions that use a proceeds-based approach to incorporating sustainability into the portfolio of bonds. This can help reduce climate risk. It can increase the impact of a portfolio. But what's really changed over the last couple of years is that this has accelerated, and it's starting to come from our insurance clients, where they're reaching out to us directly now and saying, how do we incorporate sustainability throughout our process and specifically into our investments? So we've seen it from the top down at insurance companies. It started with health clients, I'd say, a couple of years ago, and it's really accelerated across life and P&C, where they're starting to incorporate values, from the top down of the organization and saying, how can sustainability be a larger part of what we do? And then more specifically, where does it fit within our investment portfolio?
Thanks, Phil. So what are some of the potential benefits of a passive approach to green bonds?
Yeah, thanks, Paul. There are many benefits to adopting a rules-based approach to green bond investing. One notable benefit is that you remove the human element and the subjectivity that is often found in this asset class. Another is that you benefit from the rigor and consistency of S&P's index methodology. Finally, using a proceeds-based approach delivers the peace of mind that 100% of the proceeds of each bond in the portfolio goes towards environmentally sustainable projects.
Well, thanks, Phil, and Bill and Brian, all for your insights today. Really appreciate it.
Thanks a lot, Paul.
My pleasure.
Thanks for having us.
For more information on how indexing works for green bonds and to get our latest research and data, visit us at the link below. Thanks and have a great day.